All right. So my name is Gerald Jones. I am with FERS Retirement, and I manage investments for federal employees, and I do their financial planning. So when it comes to managing investments, that means things such as their TSP, maybe bonds, stocks, as well as their financial planning as far as how much income they're going to have when they're ready to separate service and retire, when they're eligible to separate service, making sure their estate is up to date, their estate planning, their insurances, social security, and taxes as well. So, as you know, or you should know, the big, beautiful bill was passed yesterday. And what I'm going to do is um, I'm going to go over how that make some changes for federal employees. For the ones that are really in service, maybe later on I'll do another live stream for federal employees that are getting ready to separate service or that are about to retire. But for right now, I want to focus on the federal employees that are still in service. Okay. What I think about this big, beautiful bill is one, at least the goal of the new administration is to really get the country to grow. Now, the big, beautiful bill itself is about almost 900 pages. Okay. I did not read all 900 pages. I'd read through the table of contents. And as I went through the table of contents, I went straight to the areas that are most important for federal employees, which is the financing section, the finance section, section 7,000s, all the 7,000s in the big, beautiful bill. Now, this portion of the bill is talking about tax relief for middle income Americans. Okay. That's the majority of federal employees. The average salaries usually start at about $50,000, usually as high as $160,000, $175,000 a year, and everywhere in between. Okay. And so with this new bill that's been passed, uh, really the main goal is to continue the taxes, to keep the tax brackets the same, so they don't sunset and they don't increase. So all the tax brackets can stay the same. And I'll go through that in a second. But the bill itself is about 900 pages, and I went through the sections that were most important. And but what's on the White House website is a summary, which is about 27 pages, which shows exactly what the new administration plans to do over the next 10 years. That I went through like a um, I went through that like a fine tooth comb. Okay, that is huge. They plan on putting so much investment into the country that it's going to spark a lot of growth that's going to outpace the debt that they are pulling, because they are pulling about $4 trillion worth of debt to do this and to make this happen. Okay. But yeah, that's really the goal, is that they're reducing taxes, get more cash flow into people's hands, have a ton of business investments that are coming over into the United States, trillions, trillions, trillions of dollars. They're making it easier for regulation, so you can build new homes, um, build in underdeveloped areas such as these, I forget what it's called, OZs, opportunity zones. So the opportunity zones are really, really important because they're going to have a lot of investors come into these underpowered homes, or these areas where they're not really the best places to live in, right? Lower income areas, and essentially they're going to regentrify these areas. Okay, they're getting you're having a ton of investors get credits. They're removing a ton of I can't think of the word. Um, Not restrictions, but they are removing a ton of where it just makes it easier so you can develop in these areas to spark growth. Now, with a lot of the changes that they have going on, based on what I read that's on the White House website, we're not going to see any changes for about 3 to 4 years. Okay, 3 to 4 years. But after year 4, from year 4 to year 10 is where we're supposed to see tremendous growth, where the growth is going to outpace. It's going to outpace the deficit that we have every year. So the reason why this is important for federal employees, if you are just a normal federal employee, clock in, clock out, you have your job, maybe you have some investments. You just essentially you want to make sure that you're working and you're doing the best, you're putting yourself in the best situation so you can separate service and retire, have a nice sizable net worth, things like that. One of the first things that we want to make sure that you're doing is that you have to make sure that you're out of consumer debt. You have to make sure all of your debts, your liabilities are paid off, except for your mortgage. Okay. So that's car notes, student loans, definitely credit cards. The reason why that is so important is because over the next 2, 3, 4 years, you've already seen the economy bounce back, right? You don't want to be the one stuck paying. Um, you don't want to be the one stuck paying debts off instead of doing your investing based on, especially for what the projections as far as where this country is supposed to go. Okay, you don't want to miss out on that because you're sitting around, paying off your credit card, or, you went into debt, got a car loans and things like that. Okay. All right. So let's jump right into it. I'm going to go over this example that I have, and let's see what we got here. Okay. So we're going to use the example of a GS-14 Step 5 with a base salary in Washington, D.C. Okay. So in this example, GS-14, Step 5, they're in D.C. With locality pay. So their base pay is $116,128, and with their locality pay, $155,536. Okay. So as I go through these steps, I'm going to go over this is an example of a single person. As I go through this, I'll be able to point out if you're married, or if you're married filing separately, how you can make adjustments. But as I go through this, you will see how this new bill is going to play an effect on your financial planning. Really, what this is right here, this is tax planning. And I'm going to show you, because of how you reduce your taxes, what you need to be doing investment wise, okay, moving forward. So $155,000 salary, which includes locality pay. In this example, we have TSP contributions. Let's say this person is under the age of 50 years old. Okay, so we're maxing out our TSP at $23,500 a year, 23.5, which is $903.85 per pay period. Okay. So with the 5% match, that's an extra, let's just call that $7,800, which is an extra $300 per pay period. So when you're maxing out your TSP and you're under the age of 50, you are actually putting away a little bit over $30,000 a year. So the sooner you can put yourself in position to do this, when you're putting away $30,000 plus a year, this is just your TSP. This doesn't include any outside investments outside of that. you're putting yourself in a position to have high multi-six figures in your retirement and or clear the seven-figure mark. Okay. So for the households that I work with, this is the goal. Some of the households that I work with, they are already here. Some of them, we have to work and make sure we get our budgets down and get their debts paid off so they can work their way up to this point. But in this example, what we have, 23.5. Okay. All right. So with their FEHB, your health insurance, annually, about $7,800 here, almost $300 per pay period. So the reason why we have it listed in this order for you to follow along is this reason. We're taking your base salary and we are reducing your annual TSP contributions. And then we are reducing or subtracting your annual health insurance contributions. Okay. What this does is this brings down how much you're paying taxes on your hardworking money. So, big picture, you make $155,000 a year. Before you're even taxed, we're already investing we are already investing a little bit over $30,000 a year. Okay. Your health insurance, pretty important here for obvious reasons. One, it's your health insurance. In my opinion, I feel like it's the best benefit that you have as a federal employee. But the reason why this is important when you go down this list is that the larger your health insurance premium, the less you pay in federal taxes because your health insurance premium is a tax deduction. So some of you may feel like you want better health insurance coverage while you're working as a federal employee. Okay. And if you want better health insurance coverage and if you can afford to increase that coverage, you get a larger tax deduction. Okay. If you have a lower health insurance premium, then your tax deduction is not as high. Maybe you want more money on your cash flow. Okay. The reason why I bring this up is because if your base salary is $155,000 a year, it's important to know where that money is going and how it's going to benefit you. Okay. So 155, we take off our TSP contributions for the year. And when we reduce our TSP contributions, we are only reducing our contributions. We are not reducing the match. Okay. So reducing the TSP contributions, reducing the health insurance contributions. So that brings our annual taxable income to about $125,000. Okay, so that difference has went to health insurance and our long-term investments. Very important, okay? Now, in this example, I threw in rental income. Sometimes a lot of folks have rental properties, things like that. In this example, we have $10,000 of additional rental income coming into the home. So, plus the rental income, we're adding that back on top. Our taxable income is now about $135,000. Our standard deduction, now with the new bill that just went into place, the standard deduction has increased to $15,750 for single filers. Now, I'm just giving you the example of a single filer. If you're married, you want to update these numbers based on your current household. So, for example, we want to put the total salary for a husband, for spouses, okay, husband and wife, or things like that. We want to put the total pre-tax contributions. In this example, I'm just using pre-tax. I know there's a Roth TSP, but I'm just going pre-tax right now based on this example, okay? But we want to put the total health insurance that's being paid out, and you can update the figures, okay? If you have rental income coming in, great. If you don't, you can remove it. and then your standard deduction. This is based on a single filer. If you're married filing jointly, you'll make the change. It's about a little bit over $30,000 if you're married filing jointly. But in this case, we're using a single filer. So total taxable income is $118,000. Okay. Now, the QBI. The reason why I put the rental income in here is because of the qualified business income deduction, which has went from 20%, and because of the new bill, 23%. This means instead of us getting a tax deduction of 20%, it's increased by 3 more percent, 23%. Okay. So this puts more money in our pocket. So another reason why I'm bringing this up is because if you've ever been entrepreneur inclined and you've always wanted to start a small business, or you do have rental properties, or you have some sort of sole proprietorship, LLC, S Corp, the income that you bring in, you get an automatic deduction of 23% up to as long as it's underneath $500,000. So as long as your small business is under $500,000, you get an additional 23% deduction on that income. So that brings our income to about 117,000 right here, 116,236, 117. Okay. That puts us in a tax bracket between 95K and 182,000. Okay. So taxes owed, 21,296. If you have a child, they increase the child credit. So this is a credit. So that credit now brings your taxes owed to $19,096. Okay, so this is a very, very, very simple structure for you to follow. This $734.46, what this is how much you should have withheld from your paycheck every pay period. Okay, 26 pay periods, 734.46. Why? Therefore, you don't owe any money at the end of the year. Okay. And I get it. Some of you like to get a refund back. That's not your best interest for you to, get a refund back. Why? Because you can be taking that money and investing it yourself and things like that instead of leaving it with the federal government. Okay. So this is a very, very simple formula here. Now, this is what's important. When you look at this structure that has been created, so let's take a look at this. We have our annual income here, right? Here's our long-term investing. Now, for my households, this is how I handle long-term investing. This is the structure that I have. One, we make sure we do not do any investing until all of our consumer debts and our liabilities are paid off. Once that is done, we want to do at least 5% into our TSP, but ideally we want to do at least 15%. If we can do at least 15%, you'll essentially, depending on how much time you have left to go working in federal service, you can do pretty well. You can do pretty well in your thrift savings plan. Okay, so we want to have at least a minimum of 15% here. If you can max fund your TSP, that's great. That's terrific. Now, the reason why I'm bringing this up in this structure is because this is our long-term investing. So once I make sure my households are out of debt, we make sure we have our emergency funds built, 3 to 6 months of your monthly expenses, maybe even 9 months, depending on where you're at, things like that, right? Usually if you're about to separate service, you may want to have at least 9 months or so worth of income, or at least 9 months worth of cash sitting in the bank. But the reason why I bring that up is that once you've had your debts paid off and your emergency fund is built, now we do our long-term investing. You have a few options. One, we could do at least 15% to your TSP. We can max fund your TSP, or we can build out your stock portfolio. So a lot of times you don't want to have, let's just say, you don't want to have everything, all of your eggs in one basket. So in a lot of cases, you do not want to have everything tied into your TSP. And this decision is yours as the investor. This is the decision of my households. I just give them their I just give them their options. So if we do put everything into the TSP, that's fine. But if you do want to reduce what you're putting into your TSP to a minimum of at least 15%, and take that overage and and start to build out your stock portfolio, that's not a bad idea either. Your stock portfolio can be stocks of publicly traded companies. It could be your dividend portfolio. It could be your options portfolio. It could be whatever exactly it is you want it to be. If you have the resources, you can also max fund your TSP and still build your stock portfolio on top of that. Or you can just keep things at 15%, and maybe you want the extra money to come on your cash flow so you have a better lifestyle. There's nothing wrong with that either, okay? The point is that you have options. So we follow this structure here to make sure we're maximizing, one, your paycheck. We're reducing our taxes as low as we can possible. We're taking advantage of our health insurance benefits here, making sure we have the right plan in place. And we go from there. So that's what I wanted to cover for you. This is essentially what the big beautiful bill. This is essentially what the bill is going over. It is keeping our taxes low so we can continue to invest. If you're still in consumer debt, the number one thing you have to do is that you have to get out of debt so you can jump in and get involved on the long-term investing, the plans that the new administration has, okay? So if this was helpful, let me know. This is my first live stream in a long time, so there's not going to be many people here. So if you have a comment, obviously, I can read the comment. Maybe I can answer your question if it's not too difficult. Or if you think this is helpful to someone else by going through this structure, go ahead and share this with them and let them, so they can get this information. But other than that, enjoy your rest of the evening. Thank you. And